Gordo, what's going on today besides the tree that's right behind you? Well, first, I got a tree. Second, federal layoffs trigger a sharp slowdown in job growth. Unemployment rises to highest rate since 2021. So, as we know, Mr. President has been going crazy and cutting jobs. This chart is slightly outdated by a few months, but you can see government jobs have been getting cut the most. And then you have technology following and warehousing, retail. You can just keep going down the list. But importantly, Gen Z's AI era hiring nightmare. How a no hire, no fire economy and automation are freezing out new grads in 2025. Well, could be because we don't have any money going around for companies to support hiring new people. And also, inflation might be going up, although that wouldn't really help them. Sometimes I get lost in my explanations. But you can see here in the job openings, every time this graph goes down, you get this gray bar. That signals a recession. So 2008, you started going down, recession, 2020, going down, you have the recession. And then over here in 2022, 2024, it went down, but they haven't called it yet. There's also the unemployment rate for Gen Z. You guys have Australia, Austria. I'm not going to name all of them. But you can see you guys are very high at unemployment. Although most of you guys are barely coming out of college soon. So there's that. Not going to be too harsh on you guys. But MIT study finds AI can already replace 11.7% of the workforce. Now, this one is bad for everybody because that means you don't have a job. And over here, I show which jobs are most likely to be replaced by AI. So far, your highest ones are production and transportation and material moving. If you guys want to know how to read this chart, just look at the purple dot. If you took a statistics class, that's your most likely target. Layoffs ticked up in a mostly steady job market. Labor turnover report suggests, and you just can't really suggest anything. We're just going into a bad market economically because we've been recession for a while. And you can see here, we can visually see all the times where we started curling over. So each of these bars are, downturn, bad times. So over here, 2008, bad time, depression signal thing, cool. 2020, nobody could get a job back then. So gray bar. Now, well, we're now curling over here on the top right. So maybe they'll signal a recession. Hopefully. But you guys are like, Gordo, I'm doing perfectly fine with my job though. I don't know why you want us to start businesses. Well, here's your wage growth tracker. Your wage is higher back in 2008 than it is now. So that's something to think about. Going off of our previous lesson now, it is lesson time. We talked about how the Fed purchases T-bills through big banks. And a correction on that is they print the money and send it to Chase's account, the bank that we use as an example, but it's not money, it's just digits on a paper. It's weird. I know it's hard to get your mind around that. But we have the Fed buying bonds from the Chase, so the T-bills. What does that do economically? Well, think of it this way. You have a giant chunk of cheese, but the closer you get to the center, the worse the cheese tastes. So you have little mice, they come over and they chew on the cheese. They all get equal chunks and it tastes amazing. Now, more mice come over and they take out the same size chunks as the first mice, but now the taste quality is decreasing. So the bond's value is the cheese. So first they start off nice and low where the cheese is nice and tasty, and then as people go more and more and more and buying more T-bills after T-bill, then everybody gets equal chunks, but the quality goes down, and the quality is representing interest rates. So with the Fed buying a whole bunch of T-bills means interest rates should go down. But as we saw in the 10-year yield, it wants to go up. And the 2-year hasn't done anything yet. It's still in that pattern. I checked this morning. Now, looking at more charts, here's your S&P 500 on the daily time frame. I said, don't break this line. You want to break the line up above if you want to go hit that investor's target. Well, guess what? You broke that line. So now, today was pretty predictable. You just went down. Cool. You're still above the 200-day moving average. So my guess is you're just going to free fall and then just hit this line here. That's the next target. So there's your S&P 500. And if it breaks this bottom blue line, it's in a pattern called a double top. And if it breaks this blue line, you move this price target here to here, and you're going to go down and hit the 200-day moving average. So wherever it breaks, it's going to be, you want to measure it out from the ends, 5.35% drop. If it breaks that line. If it doesn't, cool. But your retirement accounts are probably going to get hurt. And let's keep going. Your Dow Jones Industrial Average. You guys came up. You guys hit this trend line that goes back forever ago. And then you sat on it. And then you couldn't stay above it. So now you're going down. Now you'll most likely bounce off of this blue line. Most likely. That is your next form of support. But if you break that line, then bye-bye. You go all the way down to here. And the 200-day moving average is over here. And it's similar pattern to the S&P 500. So double top, whatever. You go down 5.40%, whatever. Keep going now. NVDA. This one I marked out, I think 3 weeks ago. I can't remember. But if you look at videos that were posted 3 weeks ago, you'll see I said, don't break this line. Well, you broke it. So now you're going to go down and hit this price target. You're getting there. You're like halfway there. And you're like, but Gordo, it went up. Yeah, and then it hit some resistance, and then now it's coming back down. They do that. And most likely you're going to come down and hit the 200-day moving average. So you still have some ways to go. And then you'll probably bounce off of it. When you learn charts, it's pretty easy to see what's about to go on. Next, here's your oil. I said you can either break up out of it or down out of it. This pattern wasn't very directional, but you broke down out of it. So oil is going to keep going down lower. If you guys love stockpiling oil and investing in it, you can look over here at the bigger time frames. Go ahead and go to the 1 month, and then you can see some ways to go. It's in a bigger pattern here. You guys probably don't see it, but if it breaks up, you'll get above the 200-day moving average, and then you'll start flying to the moon. And then I also told you guys a while ago, I said, here's your silver, here's your pattern, here's your price target, and silver, you guys are like right on that price target. You did go above it a little bit, and then you tried to go even higher, but couldn't make it. So there's your price target. Hit it. Cool. It's probably going to come back down and cool off, or it could go higher. I would say if it goes higher, it's going to get a little overextended, and the pullback is going to be a little worse, but only time will tell. And for those of you wondering, here's your gold. It's still chugging its way up slowly to that price target, and we will see soon if gold makes a brand new high. And I will see you guys Friday to see what you can actually do with T-bills. You yourself. And I hope you guys have a wonderful day. Bye.